All right, so we're just kind of talking about this right now. Markets pretty close to highs, pulled back just a bit yesterday. At the same time, we do have an election coming up. We have a Fed decision coming up. So a lot of things coming up that could move the markets. I want to ask you again, with the markets pretty close to highs, where in the market are you seeing opportunities at right now?
Yeah, good morning, Frank. Well, we really like equities. That's been a backdrop for our investment strategies at Clough Capital now for the better part of the year. And frankly, going back now a couple of years, and we think just the backdrop for some growth, inflation coming down, the Fed moving towards a more, accommodative policy, corporate balance sheets really healthy, generating a lot of cash flow. We look for opportunities to own equities. And that's not, to be kind of blasé about the backdrop for volatility and ASML's news. We had some European luxury companies
Okay.
express some
Vince,
demand
in all
issues,
fairness,
but we
though,
like equities.
like equities is a big area. I mean, is there one sector where you're really seeing opportunities at right now?
Yeah, that's a great question. So we still like tech AI, notwithstanding, again, the sell-off that was precipitated by ASML's earnings, but we have some tech exposure in the two ETFs I manage, CBLS and CBSE. We think that's a big area of growth, and we think that the free cash flow generation capability of those companies is profound. But look, it's a market now where you can find idiosyncratic opportunities. So active management can pay dividends. We
All right,
own
so
industrial companies and some other sectors as well.
you're mentioning active management. You're an active manager of an ETF, the CBLS ETF. And in this ETF, you're actually shorting a number of names that you say are consumer durable names. I'm talking about names like a Harley Davidson, a Ford, also Brunswick, the boat maker. Why are you seeing downside in these names in particular right now? We're hearing from a lot of the banks. In general, the theme seems to be the consumer is pretty strong.
I think the consumer is pretty strong, but you're seeing a trade down, right? So some of the companies that are doing disproportionately well or retailers like an Amazon or a Walmart or a Costco. But when you look at some of the consumer durable purchases, right, where you need to have financing at higher interest rates, where you have a lot of inventory starting to build up. So we do love equities. We're really bullish here, as I mentioned, but we are more cautious on the consumer durable part of the economy.
So you're just saying that it's basically discretionary spending you think is going to pull back, but overall the consumer is pretty strong.
Would agree with that.
Okay. Bank of America out yesterday with a list of some stocks that they say have stable dividends. They're saying the dividends are going to be a bigger part of total returns going forward than maybe they have been in previous years. Some of the names are regional banks like Zions Bancorp, also Kenview, a number of names there. We don't have to go over all the names, but I want to ask you, in your mind, is right now the time to pivot your investment strategy more towards dividends as opposed to looking for price action on the actual stocks you're buying?
It's a great point. So we think there is a shortage of yield. And, we've had a 40-year secular decline in interest rates, and that was kind of detoured or sidetracked by the COVID response, right? All of the stimulus, monetary and fiscal. But we go back to a demographic landscape where, spending of baby boomers is in decline and yield is really hard to find. So we think rates will continue to go lower. In that context, Frank, we would be looking for securities that have free cash flow yields, dividend yields, or corporate bonds. Frankly, right now, you're not getting much of a spread on corporate bonds. So the ability of companies, again, it's why we go back to this tech AI trade. It's not just, kind of the top line growth. It's look at these capital structures, look at the free cash flow generation of these companies. And in a world where it is getting increasingly difficult to find yield, we'll look for free cash flow yield amongst equity names in the portfolios.